Hello and welcome back. In this episode, we'll be tackling this meme I saw from the page Tax the Rich, which shares a tweet from Robert Reich, which says, "This is a truly staggering fact. Wall Street bonuses totaled $27.5 billion last year, which is more than 3 times the combined annual earnings of all American workers employed full-time at the federal minimum wage. We can and must raise the minimum wage and tax the rich." Now, for those unfamiliar with Robert Reich, he's a popular figure on the left. He's been in and around politics now for decades. He's actually the labor secretary under Bill Clinton, and currently he's a professor at UC Berkeley, as well as just an all-around political commentator. If we look at the original tweet, we can see that this received a significant amount of traction on social media, lots of likes and retweets, and as we'll soon find out, this claim even got picked up by more mainstream outlets as well, so it wasn't just limited to left-wing activists. So let's see how the claims check out. If we type in a search for this claim, the first result that comes up is an article from CNBC, which is a mainstream source, supposedly respectable source, and it appears to echo and agree with the claim that Robert Reich was making. So already this is a different start from the last episode. If you remember, the first couple results basically said that the meme's claim was BS. So now here we have a mainstream article that appears to corroborate the claim. Also different from last time is that the date is recent. It's not over 10 years old on the article. We have an article that's quite recent, so it should have the latest data and statistics to go on. So let's check it out. Here's the CNBC article with the headline, "Wall Street bonuses were 3 times the earnings of all full-time workers making federal minimum wage." Now remember the rule number 2 from last episode, which was to never trust a headline. Make sure that you always read the article carefully if you have any hope of finding the truth. So we'll go ahead and do that again here, starting with the first 2 paragraphs. "Wall Street investment banks are infamous for the hefty bonuses they often dole out. In fact, in 2018, the bonus pool for the 181,300 security industry employees who work in New York City was $27.5 billion, according to the Office of the New York State Comptroller. If that sounds like a lot, it is. That amount is more than 3 times the combined annual earnings of all 640,000 U.S. workers employed full-time at the federal minimum wage, according to a new analysis from inequality.org, a project of the progressive think tank the Institute for Policy Studies." Okay, so we've gone from a pretty authoritative sounding headline now to the article citing a study from a progressive think tank called inequality.org. And if you remember from last episode, we had rule number 3, which was to never trust a reporter's interpretation of a study or data. So that'll definitely apply here as we take a look at the analysis from inequality.org. But first, I'm going to make another rule. I think we're up to number 4 now, and that's to always click on the links in an article. You will be amazed sometimes at what you find when you click on the links. Oftentimes, there'll be context which runs counter to the article, or sometimes even information that directly contradicts the article. In this one, we'll click on this link for the Office of the New York Comptroller. Here's the report from the state comptroller with the headline, "Wall Street profits rose in 2018, but bonuses fell." Probably not the headline you're expecting. If we continue, securities industry's profits in 2018 were 11% higher than the previous year, but the average bonus paid to industry employees in New York City declined by almost 17% to $153,700. So considering the CNBC article was meant to highlight the largesse of Wall Street bonuses, most people would be pretty surprised to learn that they actually declined, and declined quite substantially over the course of 1 year. In fact, you could have an alternate article citing the same report here with a completely different narrative, something like, "In an age of rising Wall Street profits, bonuses fell." Now, it should be pointed out that even though the bonuses declined, your average financial worker still earns a substantially higher salary than the rest of the city workforce. But this shouldn't really be that surprising to most people, considering the reason people become stockbrokers and investment bankers and put up with all the stress and competition is usually to make money, and make a lot of money. That's how it's always been. That's how it probably always will be. But as it relates to the bonuses, this report actually runs counter to the narrative of the article. To be fair to this article, they did disclose this, although they buried it a ways down in the story, but here we can see they did mention that the bonuses fell 17% from 2017, although they tried to diminish this by claiming that the overall trend has been upward. And this is also sort of misleading, as we'll soon find out, but at least they did disclose it, whereas the meme by Robert Reich did not. The next thing we need to take a look at here is that study they link to from inequality.org, as that is the basis for most of their claims here. So let's go take a look at that. Here's the inequality.org article that they link to. If you spend any time on this site, it becomes pretty apparent that its sole purpose is to push a particular agenda. They're big on highlighting income, gender, racial inequality, things like that. For example, today they posted this, that tennis should be for everyone. I guess they're upset that Wimbledon tickets cost so much, so apparently I guess everybody should be able to afford Wimbledon tickets. I'm not exactly sure, but that's kind of what you're going to get with this website. It's pretty unbelievable that a news article would even link to a source like this for their data, but unfortunately it's all too believable. I see it all the time, which is why it's so important to click on those links. But even though this is a biased source with an agenda, that doesn't necessarily mean that they're wrong. Biased sources can point out important and relevant facts. We just have to keep in mind where they're coming from. So with that in mind, let's see what they have to say. The first claim that this analysis makes is regarding the Wall Street bonuses versus the minimum wage. And here's where the CNBC article and meme get its talking points from, where it says the bonus was $27.5 million last year, more than 3 times the combined annual earnings of all 640,000 U.S. workers employed full-time at the federal minimum wage. And a little lower, they have a chart here that compares the average Wall Street bonus to the annual federal minimum wage. This chart's actually pretty interesting because we can see that not only did the bonus decline in 2018, but it's actually lower than if we go back to 2006 or 2007. In fact, quite a bit lower, about 20% lower, and that's not even factoring in inflation. If we correct for inflation, it's about 30 or 40% lower than it was prior to the last recession. So you can see from this chart, we can create several different narratives depending on our perspective. One is that there's an overall upward trend in Wall Street bonuses. If we go back 30 years or 20 years, even 10 years ago after the recession. Another narrative could be that the bonuses have stagnated or declined since the last recession or the last 10-15 years. If you're trying to make a pro-Wall Street case here, you could lament that bonuses have declined by 30 to 40% in real terms since before the last recession. Still, another narrative is that Wall Street bonuses are very volatile. They rise and fall according to the markets or other factors, and over the last 2 or 3 decades, markets have risen spectacularly. Along with it, bonuses have tended to rise as well, although they've spiked and fallen along the way. So, as we can see, this chart could have several different narratives created. But let's zero in on their central claim, which is that the bonuses were more than the combined annual earnings of all 640,000 U.S. workers employed full-time at the minimum wage. And remember rule number 4, which says to always click on the link in an article. This certainly applies to an article like this. There you're already worried about the bias and lack of objectivity. So let's click on their link for the 640,000 minimum wage workers. This link brings us to the Bureau of Labor Statistics report on the characteristics of minimum wage workers for 2017. And the relevant section we want to go to here is down in the highlights to full and part-time status workers. See, it says see table 1. So here's table 1. This table breaks down all the minimum wage workers into different categories. If we go down towards the bottom here, we find the section on full-time workers. And here we see the number 640. That's in thousands, so that's 640,000 total full-time workers. So that's where the article gets that number from. But if we scroll up here, we see that that's the total number of workers, which includes at minimum wage and below minimum wage. So this is very important because, as So you see here, of that 640,000, only 130,000 made the minimum wage, while 510,000 made below the minimum wage. Okay, so only 1/5 of that number earned the minimum wage, and the rest earned below it. Now you might be wondering how somebody can make below the minimum wage when it's the minimum wage, but the government does actually give exemptions to certain groups. For example, some farm work is exempt from the minimum wage. There's tipped work. Certain employees under the age of 20 can actually be paid below the minimum wage for up to 90 days. And then there's certain groups like the mentally and physically handicapped, which can also be given exemptions. But obviously raising the minimum wage won't affect these workers because they're already making below the minimum wage. So if we are looking just at the full-time workers who earn the minimum wage, which is what the article claimed, again, we only see 130,000, and percentage-wise, it's only 0.2% of all hourly workers. So very, very small percentage. Almost nobody is working full-time and making the minimum wage. Now, ironically, this actually makes their claim even greater. Instead of Wall Street bonuses being 3 times greater than all minimum wage full-time workers, it's about 5 times that, so about 15 times greater. But at the same time, this makes their claim far less compelling. Getting back to the meme, I can now make an assessment on it. I could have given it a false rating since technically Wall Street bonuses didn't total 3 times the combined annual earnings of all workers employed full-time at the federal minimum wage. It was more like 15 times, but since that mistake works in their favor, I think the misleading tag is more appropriate. As it stands, there's nothing truly staggering about this fact at all. As we saw, bonuses actually declined 17% from last year, and they're still 20% lower than their pre-recession highs, despite the fact that the current stock market is much higher, as is the size of the overall economy. And of course, hardly anybody who works full-time makes the federal minimum wage anyway. As we saw, it was just 130,000 workers, or a minuscule 0.2% of all hourly workers make the federal minimum. So this meme's reasoning to raise the minimum wage kind of falls flat here, especially considering we saw that the bulk of the workers who made right around the minimum wage actually earned below it, so they wouldn't even be affected by raising it in the first place. And this doesn't factor in the economic cost of raising the minimum wage. Thanks for watching. Remember to click subscribe to help this channel continue to grow. Also link to the sources that I used in the video description in case you wish to check those out. Until next time, so long.